Thank you for joining us for another episode of the Dealmaker series. Today, I am joined again by Amanda Foyt. She is VP of Middle Market Banking with Comerica Bank. Amanda, thanks for being on again. I think it's been almost exactly 6 months since we spoke last on here. How are you doing today?
Good and great to be here. Thanks so much for having me.
Absolutely. So I think this will basically be kind of like a what's changed since last time, but let's jump right into it. Well, actually, let's you can give a little bit of overview for those that haven't seen the first episode with you on it. Tell us a little bit about yourself and what you do at the bank.
Sure. So, like James said, I'm a vice president here at Comerica Bank, and I am in the middle market division of the bank. I lead a pretty strong portfolio. About half of it is private equity backed businesses where we're banking and financing the underlying portfolio companies. And the other half is a mix of owner managed privately held middle market companies, primarily in manufacturing and distribution and industrial services. And we also do quite a bit in ESOP financing, which I enjoy and have really strong partners in the market. And I am based here in Dallas, really strong market. Haven't seen a lot of slowdown here. So, no shortage of things to discuss today.
Yeah, no shortage indeed. A lot has been happening, especially here in DFW. So let's talk about the deal flow. You mentioned that you haven't seen much slowdown. What does that look like for you right now?
It's still been a strong M&A market from our standpoint. I mean, the private equity firms and sponsors that we tend to partner with have an abundance of capital to deploy in the market. They've just finished raising new funds. There's new SBIC funds that are coming out that we're supporting. And also with our private equity sponsors raising those funds, we'll come in as an LP investor actually in some of them. So we have really close ties. It's all about relationships. But once you get that tenure and institutional experience with a bank, it can go a really long way where, we can be a little bit more aggressive and meet the asks of our sponsors that we've done a lot of work with before. I've been seeing some smaller deal flow come to fruition. That probably is a testament to just exposure levels and diligence requirements of larger companies being a really big haul these days. I think lower levels of investments are easier to get approval and support for. And I even see that to an extent at the bank as well. And valuations, I think, in our sphere have been coming down a little bit. Other factors in the marketplace we can talk about have attributed to that, but they've been pretty fair asks with pretty fair companies, where there's low hanging fruit for these private equity sponsors to come in, help professionalize the business, and execute kind of the traditional private equity playbook. We haven't been seeing anything too wildly different. Other than maybe a few sectors, interesting stuff coming out of manufacturing and industrial technology that I've really enjoyed seeing. I can speak to a little bit later, but it has been active for us through the second half of this year. And I've even been seeing a little bit more heading into the end of the year with just presentations crossing my desk and from numerous different sources. So it seems like the market is picking up with mandates and financing activity heading into the new year.
Yep, that's good to hear. I've been picking that up as well. It's somewhat of the consensus for a lot of folks. I'm curious if this is maybe a factor of deals that didn't get started until later in the year because of the turmoil that we were met with earlier this year when you and I last spoke, or if they're just, trying to get deals across the line or get them launched at least where all of that dry powder is getting impatient. What are your thoughts
Sure.
on that?
Mid year coming out of a lot of the tariff turmoil specifically, I think that was kind of a headwind for a lot of sponsors when they were going through diligence, seeing companies that might have more exposure into international importing, that these were great companies, strong margins, but let's see how things. I saw a few deals put on pause for that reason, just to see how tariffs landed, how rates and how you actually govern and report and code the inventory that you're ordering. Sponsors wanted to see how that would get normalized through year end and how year end performance shakes out before making a big decision to invest and make companies, their platform investment. So certainly saw a little bit of that. And there was, I think, it was a good thing to see rates come down a notch. That alleviated some pressure from companies, but then you got this wave of more macro related issues like the tariffs that we were talking about. That, it seems like no day has a shortage of something new for these businesses to consider and new
Yeah.
hurdles to overcome day in and day out.
Yeah, that has very much shaped a lot of the activity in the markets across the country. What about deal structure? Are you seeing any sorts of structures in particular in this second half of the year that are cropping up?
Not necessarily anything wildly different. Like, I'm not seeing, for example, I think at certain points in time, you may see more considerations get lumped into some sort of earnout that's multi year. I've actually been seeing a little bit less of that. Um, I've been seeing um, on the SBIC side with some of our sponsors, there's big trends with just how the deals are coming about, a lot more partnerships across the board with independent sponsors, finding deals, bringing them to these institutional funds that have raised a lot of capital. And those deals are becoming more and more viable. For example, I mean, one of my sponsor relationships, every deal I've seen from them on the SBIC front has been from an independent sponsor firm. And I guess those structures, I mean, depending, the ones I've been seeing come through have been lighter senior debt requests. And this is a little specific to my role, but you'll see these sponsors really capitalize these platform investments from an SBIC fund using all of their own capital. So they would be contributing the cash equity and subordinated debt, if you will. That'd be the only capital to the structure where they would look to us as they continue pursuing growth, whether that be add on acquisition activity or otherwise. We'd come in to refinance and finance some of that forward growth. So I have been seeing those trends. And on the independent sponsors that are bringing these, I mean, I've seen particular edge from them when they have tenured backgrounds in a respective field where they can be more operationally beneficial to these investments. So for what that's worth, I have seen an uptick in those deals.
Yeah. Interesting. I have not heard anyone talk about SBIC yet, so that's interesting. That's new for me. I'm gonna have to keep tabs on activity there. What about industry wise or sector? You mentioned sector as maybe changed since we last spoke. Where are you finding a lot of activity?
Well, for me, I mean, being at Comerica Bank, I think Comerica Bank tends to focus on more traditional asset classes. And that's similar and pretty well aligned with a lot of the private equity, middle market private equity firms around the country that are looking for industrial services, manufacturing, distribution. But I have enjoyed seeing a few opportunities more in the technology advancement side with companies that are, promoting and engineering products that yield zero carbon emissions on these production sites or on these land clearing and agricultural sites. And those innovations, in 10 years ago, when I was on the advisory side, not as a commercial lender raising capital, I remember seeing companies like this that were kind of more at the start of their R&D looking for capital, but they weren't ripe for private equity yet. It was more venture capital or trying to seek some form of debt that might be less dilutive. So there was less of a market for these companies that were trying to make innovative technologies that would change the landscape of these end markets, but just didn't have the access like they do now to private equity. And so that's, I think, an exciting inflection point. I'm looking forward to the day when I see more investment in artificial intelligence in these middle market businesses. That hasn't come as a wave quite yet, but I have heard rumors or certain firms that are taking it upon themselves to maybe build out a platform that would look like a traditional private equity playbook, but maybe also acquiring or developing in-house an AI platform that could go to all of the underlying portfolio companies and benefit them. So I'm looking forward to the day that I see more in that because I do think that that is the future, and middle market companies that don't integrate that into their business will fall behind long term.
Yeah, for sure. Everyone is still pretty much scrambling to try to figure out how to integrate AI into their operations or enhancing some element of their efficiencies. So likewise, I'm looking forward to seeing how that'll unfold over the next few years. We've kind of touched on the tariffs and the interest rate policy that's kind of been shifting now here toward the end of this year. What other commentary or insights do you have around that? I know that interest rates have been, from what I've been gathering this year, been holding up deals quite a bit. So now they're coming down. At the time of this discussion, I think they've lowered twice now. So
Mhm.
what kind of commentary or insight do you have around that?
Yeah, October was the last rate cut for us, right? And we do stay in pretty close touch, like our group specifically here in Dallas at Comerica with our swap desk representative, where we get some nice insights on interest rate movements and where yield curves are trending. And I think from the last time we spoke mid year to now, there are fewer rate cuts baked into the yield curve, which kind of signals that there might not be as aggressive of a push for rate cuts coming down the pike. But still, since we've had some lowering this year, that's certainly helped. I think it's helped across the portfolio too, just with trends and companies meeting their budgets. It's certainly helped alleviate some pressure. And tariffs, there's still some uncertainty, but it seems like I just got off a call this morning with a company here in Dallas. And the way that they're planning, they actually are more of a domestic supplier where they see, I think, 50% international import tariffs being applicable to their product for competitors that are sourcing abroad. And that gives them the fact that they're not sourcing from abroad just gives them a real competitive distinction where once those tariff rates are applied and are more normalized, you're going to see those competitors having to raise their rates in order to accommodate. And that gets passed through to their customers. Well, what happens then is that the domestic suppliers without that burden can continue to supply products at a competitive rate and will be just more competitive in the market.
Yep. Do you think there are any other elements right now that are at the top of owners' minds or sponsors' minds other than interest rates and tariffs?
Maybe with just planning for upcoming administration changes, I think there is kind of a timetable set for a lot of the investors in the market to implement their growth strategies, get what they need done over the next 18 months. For companies that have been held in their portfolio for maybe 3 years or longer, they're thinking, before the next administration and the new administration gets set, let's make a goal to attempt realizing this exit if it's the right time.
Yeah, for sure. That's a good point. Very good point. Something to consider for sure for um, both deal makers and business owners is what might be coming down the line as far as administration changes. Okay, last question. And we'll look into the crystal ball again. What shift do you see coming next? What major shift do you see coming over the next year or so in the M&A space?
Well, I'll probably speak from my direct experience and exposure from the lender banking side. There is certainly an uptick in bank mergers and acquisitions, Comerica being one of them. We are merging with Fifth Third, and that's been exciting news. Lots of positive response in the market. But there are other really large transactions occurring as well, like Huntington with Cadence. There's a number of other large, substantial transactions occurring over the next 6, 8, 12 months. And so that consolidation may impact things, right? And I was thinking about this, I think everyone, as they consolidate, you end up moving up market. So I could see that being a potential pressure point for lower, smaller, mid sized companies that have been able to get bespoke financing from regional lenders, that as everyone moves up market, those transactions may be harder to find financing. And that's speculative. Um, I think there's a lot to sort out and see what the criteria looks like once those mergers happen. But I still think there's going to be strong support for the capital out there that's raised and committed and trying to find a home, and for the sponsors and companies that are structuring their transactions appropriately. And still, relationships are going to be key, I think, no matter what. But the consolidation, it will have an impact. But again, I think greater resources are a good thing. And once you see that consolidation, you'll be able to offer more to your clients than ever before. So there will be pros and cons, but overall, it's exciting. We will see that over the next year for sure.
That is a very interesting point about how once you've got kind of the consolidation, the company tends to move up market. Because this year, one of the themes I've picked up on is how capital is coming down market, even if it's coming from outside of our state, just across the board. It's starting to move down market, and so with those kinds of consolidations happening, that'll be interesting to see how that could unfold. To your point. Amanda, I appreciate your insights as always, and thank you for your time. Those of you watching, I hope you found this insightful. You can find more episodes of the Dealmaker series on my YouTube channel, and you can follow me on LinkedIn for more. Thank you so much, and thank you, Amanda.
Thank you.